Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The Federal Reserve meets March 18th, and markets are treating it like a foregone conclusion. CME FedWatch shows 94% probability of a hold at the current 3.5 to 3.75% target range. But here's the problem with consensus trades. Fed Governor Christopher Waller just called this decision a genuine coin flip. That language matters. According to ROIC News, Waller stated on February 23rd that the March meeting outcome depends entirely on February employment data released March 6th. When a Fed governor uses coin flip terminology 11 days before blackout period, you pay attention. Let's establish the policy framework. The Fed cut rates 3 consecutive times in late 2025, bringing the target down from restrictive territory. Now they're parked at 3.5 to 3.75%. The median FOMC forecast still projects 2 cuts for 2026 overall, but internal division is running high. Waller himself dissented at the January meeting, pushing for a 25 basis point cut when the majority voted to hold. That tells you the committee is split, and split committees create volatility. The labor market is the hinge point. According to PY Ment's reporting, 2025 marked the worst year for job creation since 2003. That's not statistical noise. That's a structural warning signal that has Fed officials spooked about labor market fragility. Waller and other officials are watching unemployment closely. Analysis from E8 Markets indicates the Fed views 4.3% unemployment as a critical threshold. If jobless rates push above that level, expect dovish pivots. The February jobs report dropped March 6th, giving the Fed 12 days to digest the data before their decision. If that report showed weakness, particularly in payroll numbers or upticks in unemployment, the coin flip tilts toward a cut. If it stabilized or improved, the pause holds. Now flip to inflation. Core CPI hit 2% recently for the first time in years, right at the Fed's target. That's progress. But it's fragile progress. According to Cleveland Fed Inflation Nowcasting, February CPI figures expected March 11th are projected in the 2.41 to 2.6% range. Core measures are supporting the trajectory toward target, but services inflation remains stickier than goods. Fed officials are hyper-focused on whether this disinflation continues or stalls out. Here's the tension. Labor market data says ease. Inflation data says caution. The Fed is caught between competing mandates. Ease too early and you risk reigniting price pressures. Hold too long and you compound labor market weakness. This is why Waller's coin flip comment resonates. There's no clear dominant signal forcing the decision one way or another. Market positioning reflects this uncertainty. Equity markets, particularly rate-sensitive tech and QQQ, have been volatile around Fed communications. Technology stocks price in future cash flows, making them acutely sensitive to discount rate changes. Financials also move with rate expectations since banking margins depend on spreads. Right now, markets are pricing the hold, but option skew suggests traders are hedging for surprises in both directions. Fixed income tells a similar story. Treasury positioning in TLT reflects stable rate expectations, but long-duration bonds face significant risk if the Fed pivots dovish. A surprise cut sends yields lower and bond prices higher. Conversely, hawkish language or stronger data could pressure duration exposure. The March 11th CPI release becomes a critical risk event for fixed income portfolios. Crypto markets are showing tight correlation with Fed policy. According to Quira analysis of Bitcoin sensitivity to Fed decisions, Bitcoin has been trading around $87,000, with analysts projecting potential moves toward $100,000 if renewed rate cuts inject liquidity. Digital assets have developed inverse relationships with real yields. Lower rates mean lower opportunity cost for holding non-yielding assets like Bitcoin. If the Fed cuts, crypto likely rallies. If they hold and signal extended pause, crypto faces headwinds. Let's wargame the scenarios. Base case, the Fed holds at 3.5 to 3.75%, cites data dependence, and keeps optionality open for future meetings. This is the 94% probability outcome currently priced. Market reaction would be muted unless Powell's press conference shifts tone significantly. Watch for changes in dot plot projections and any adjustment to the two-cut median forecast for 2026. Dovish scenario: February jobs data comes in weak, unemployment ticks up, and the Fed cuts 25 basis points. This triggers immediate market reactions. Equities rally, particularly growth in tech. Bonds rally as yields compress. Bitcoin pushes toward the $100,000 level on renewed liquidity expectations. The probability is low based on current pricing, but Waller's comments suggest it's live. Hawkish scenario: inflation data surprises higher, labor market stabilizes, and the Fed not only holds but signals extended pause or removal of future cuts from guidance. This is the tail risk nobody's pricing. Tech gets hammered. Financials could rally on higher for longer rate expectations. Bonds sell off, and crypto faces pressure. Low probability, but high impact if it materializes. The actionable framework here is understanding the data dependencies. February jobs report dropped March 6th. That's your first signal. If payroll's disappointed, if unemployment rose, if revisions to prior months were negative, the dovish case strengthens. If the report showed resilience, the pause extends. March 11th, CPI data is the second gate. Hot inflation readings complicate any dovish pivot, even if labor weakens. Cool inflation readings give the Fed flexibility to ease if labor concerns dominate. According to Oxford Economics Analysis, the recent uptick in core PCE isn't signaling sustained inflation for 2026. That's important context. It suggests the Fed has room to ease if labor market conditions deteriorate without immediately triggering inflation concerns. But the Fed won't act preemptively. They'll wait for confirmation in the data. Let's talk sector implications. If the Fed holds as expected, defensives and value likely outperform growth in the near term. Higher rates for longer favor profitability over growth multiples. If they cut, you want exposure to rate-sensitive growth, particularly in tech and small caps, which benefit disproportionately from easier financial conditions. Financials face cross currents. Rate cuts compress margins, but easier policy supports loan growth and reduces credit risk. For fixed income positioning, the curve is pricing very little volatility. That's an opportunity for those willing to take convexity bets. If you believe the dovish scenario has higher probability than 5 or 6%, long-duration treasuries offer asymmetric upside. If you think inflation risks are underpriced, shorter duration or inflation-protected securities provide defensiveness. Crypto traders should watch the real yield dynamic. Nominal rates matter, but real yields adjusted for inflation drive crypto correlations more tightly. If inflation comes in hot, but the Fed holds, real yields stay elevated, pressuring Bitcoin. If inflation cools and the Fed cuts, real yields collapse, supporting crypto. The March 11th inflation print becomes the critical variable. The broader macro context matters too. The Fed isn't operating in isolation. Global central bank policy is loosening, creating dollar strength dynamics that complicate U.S. export competitiveness and corporate earnings for multinationals. The Fed's decision impacts not just domestic financial conditions, but also cross-border capital flows in currency markets. One final point on Fed communication strategy. The shift toward data dependence and away from forward guidance creates higher frequency volatility around economic releases. Every jobs report, every CPI print becomes a potential policy inflection point. That's very different from the forward guidance era where the Fed telegraphed moves months in advance. For traders, it means you can't tune out mid-cycle data releases. Each one carries policy implications that move markets immediately. The March 18th decision isn't just about whether they cut or hold. It's about the signal they send for the rest of 2026. Does the median forecast still show 2 cuts this year? Do officials sound more concerned about labor or inflation? Does Powell push back against market pricing for future eases or validate it? The dot plot, the statement language, and the press conference will all matter as much as the rate decision itself. Bottom line, Markets are priced for a hold, but the Fed itself is uncertain. That gap between market confidence and Fed ambiguity creates opportunity for those positioned to react to surprises. The February jobs data and March 11th inflation release are your signal events. Position accordingly, manage duration risk, and don't ignore the tail scenarios just because they're low probability. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.